Hello, welcome everyone to the Monday market update. This is yours truly, Kyle Kohler. I really hope you guys had a great holiday weekend with Christmas. You'll be able to spend time with family, you're able to relax, and let's get back at it. Let's start and talk about this week. So, volatility meter here, you see that it is low. Want to know why? Because there's really not much going on this week. It's still holiday mode. But rates, as you've seen, they started at 6.24% and they trickled a little bit down at 6.2. Now, this is conventional loans. Majority of these have a 1 point buy down. What that means is if you have a $400,000 loan amount, 1 point is going to be $4,000 to get that rate. This is a very generic scenario, but you can get good rates in the fives for FHA and VA loans. And there's also opportunities right now in this market to get temporary, permanent buy downs through seller concessions. But overall, we're seeing rates dip a little bit at the end of the quarter. There's some incentives depending on the lenders. It's a great time, I say, for loan officers to lock some of their loans right now, just because some of the incentives for these lenders are out there, especially on the wholesale side. So if you're a loan officer watching this, make sure that you're checking all your loans in the pipeline, especially your pre-approved clients, seeing what's going on, seeing what investors offering a great, what's called a strike rate, where, yeah, maybe 6.2 is going to be less than that 1 point buy down that we're talking about. Maybe it's a good scenario for your client. So take a look at that. That's kind of where rates are at. But right now, I'd say volatility is going to be pretty low. So it should be pretty good there. But yeah, that's your last week's rates. Let's talk about last week's economic news. Now, you see a lot on this chart. There's a lot going on. I'm going to talk about probably 7 of these. So let's just start. First, let's start with what the ADP employment change. Think of this as the private sector vibe check, right? There's a hiring pace right now. It went down to 11.5 thousand, down from 16.25. So companies are still hiring new people, but they aren't a massive rush like they were last month. I would say it's more like a game of musical chairs where only a few new chairs are being added. So that's the ADP employment change. And honestly, of these 7, I really, really want to talk about the initial jobless claims about last week. So we'll dive through that in a second. But number 2 here that you see on this screen is the GDP annualized, GDP report, right? It's the country's hustle. So the number's at 4.3%, which was way higher. They were expecting 3.3%. And, the story about this is it really is kind of the main character of this list from what kind of went on last week. It's the final score of how much stuff the U.S. made and sold. We blew past expectations. That's basically meaning the country is working a lot harder and producing more than the experts predicted. Now that goes into the gross domestic product index here. You see the price index. This is the hidden markup. That number at 3.7 also higher than 2.7. Both of those higher. So if the GDP is the score, the price index, this is the cost of entry. It shows, that while we're making more stuff, that cost to make that stuff is also jumping up. We're winning, but the game is getting a lot more expensive to play. Let's take a look at the PCE prices. So this is like the shopping cart check. So that number there at 2.8% to about 2.9%, the goal is 2%. So we're still a lot higher than that. So basically this right here, what a PCE price is, This is how the government measures your daily life costs. So that's food, that's clothes, that's gas. Since it's stuck near 3%, it means your money still isn't going as far as it used to. The fever of high prices really hasn't broken through yet on this, this PCE price. So we'll see what happens there. And then number 5 I want to talk about here on this list is the durable goods orders. This is the big bet check. That number is at 2.2%, but 0.2% if you ignore big planes or cars. So what this does is it tracks huge stuff, big stuff. So like washing machines, airplanes, cars. The drop shows, people are scared to buy a new car or a jet right now, but they're still buying regular stuff like laptops, phones. So people are saving up instead of really splurging some of the big, purchases. And then industrial production here, this is the factory power, guys. So this checks the machines of America. Factories and power plants, they're still humming along and producing more than they did last month. The industrial, I would call it the industrial engine is still running pretty smooth right now in America. And then last, this is the main one I wanted to talk about, is the initial jobless claims. So it came in lower. It was lower, came in at 214,000. Think of it, the initial jobless claims as a security check. So it shows how many people lost their jobs last week. Since the number is lower than expected, it means the job market is actually really solid. Most people are staying employed. Well, the reason I'm saying that is because this figure is low and dropped. Most employers are not laying off workers ahead of Christmas unless they really want to be the Grinch. So this number does not necessarily match up, I would say, in my personal opinion, with the job losses we've been seeing in the labor market reports. But the growth and the biggest thing that I think that offsets this, guys, is the gig economy. Could explain some of this disparity. When someone is let go and they file for benefits, in many cases, they can only get $400 per week, which will likely not cover their expenses and their insurance. So what do they do as a result? They're forced to work in the gig economy. What is gig economy? That is Uber, DoorDash. Some are working side jobs as Amazon drivers, picking up during the holidays. Some are UPS. They're just part-time. They're basically setting up with UPS and Amazon as a contract for 3-4 weeks, and then they're trying to compile as much money as possible. So the amount of gig workers has increased by somewhere between 5 and 10 million from last year. Without this increase, we would probably likely see initial weekly claims around 300,000. So, it's a big disparity there if you think about it. And it's not really something I think that should be used and helping us in this reports, because it's not something that's long-term. When it's not long-term, it's not really going to help the economy. It's not really something great to measure, right? Continuing claims, or those continuing to receive benefits after initial claims, rose to 38,000, a little under, 1.9 million, or over 1.9 million. And this is near some of the highest levels since November 2021. So it's continued to show that once someone is let go, it's hard to find a job because of less hiring. So the big conclusion here, out of all these 7 points together, here's the headline. The economy is moving fast, so there's a high GDP, and people are keeping their jobs, overall, low jobless claims, I think, because the gig jobs are bailing them out. But prices are still staying high with the high PCE. And so they're saying overall, because the economy is so hot, mortgage rates won't likely drop anytime soon. So that's last week. Let's go about this week. Let's talk about the New Year's week checklist. So number 1 you see here is the pending home sales. So I like to call this the handshake check. What it is it counts homes where a buyer and seller have signed a contract, but the deal hasn't officially closed yet. So the goal is experts expect, I would say, a small 1% growth. And it's just a sneak peek at the future. Since it takes about 2 months to close a home, this tells us how many people are moving into new homes early 2026. If this number is high, people are feeling confident about their money. So we'll see what happens there. Number 2 is going to be the housing price index. I call this the home value check. So what it is, this tracks whether the price of a typical single family home is going up or down. Their goal is a tiny increase of 0.1%. Very small. Think of this as the home equity vibe. If prices go up, homeowners feel rich and spend more money. If they go down, it's easier for new buyers like you one day, if you're a first-time home buyer looking at this, to afford a house. Big one here, Chicago PMI. I call this the Midwest Business Check. So what this is this is a survey. It's the business bosses in Chicago area about their orders and their hiring. Their score that they're trying to get to goal to is 39.5. In this game, anything under 50 means things are slowing down. A score of 39.5 means Chicago's factories and businesses are currently taking it slow and not growing as fast as they used to. And number 4, initial jobless claims. This is the year-end job check. So what this is the final weekly count of how many people lost their jobs right before the holiday spend. The goal, they say here, it's going to be 220K, slightly higher than last week's. And this is going to be obviously the safety net check. Even though it's the end of the year, we want this number to stay low. If it jumps too high, it means the team is starting the new year with, fewer players. So interesting stuff here. I would say this week's going to be quiet because of the holidays, but the housing price index is one to watch. If house prices stay high, it makes it harder for our generation to buy homes, even if we have good jobs. So interesting stuff, but it will be overall quiet. Let's talk about this chart. This chart can be very daunting if you don't know what is this? It's a lot of numbers, a lot of colors. Let's talk about it. So this is the CME FedWatch tool. It shows what the market thinks the Federal Reserve will do with interest rates at future Fed meetings. It does not show what the Fed promised. It shows what traders are betting on right now. Think of this like a crowd prediction. It's not necessarily a guarantee. So what is the Fed fund rate? The Fed fund rate is the interest rate banks charge each other overnight. It sets the foundation for all other rates like mortgages, car loans, credit cards. When the rate is high, borrowing is expensive. When the rate is lower, obviously the borrowing gets easier. So let's talk about how to read this chart because it's a lot. Each row is a future Fed meeting date. Each column you see here is a possible interest rate change. Each percentage shows the probability the market assigns to that outcome. That percentage in each row allows, always adds up to 100%. Always. So let's give an example here. If a meeting shows 60% in one column and 40% in the other, the market thinks one outcome is more likely but not guaranteed. Let's talk about the range here on this. 275 to 300 means a lower rate environment. 300 to 325 is slightly higher. 325 to 350 is higher. And 350 to 375 is the highest range shown. Higher range means tighter money and higher borrowing costs. A lower range means easier money and lower borrowing costs. Now let's walk through the story by time period. So we got early 2026. January 28, 2028, they have an 80.62% chance of 350 to 375 and a 19.38% chance to 325 to 350. Now, what does that even mean? That means the market thinks rates will still be high at the start of 2026. They have a very low confidence in rate cuts happening by there. Now, in March, you see 60% chance of 325 to 350 and a 39.45% chance of 350 to 375. What that means is that the market is beginning to expecting the first real rate cut. Still split, but pressure starts building up. They're going to project towards lower rates. Now, spring to summer 2026, this really kind of breaks through where markets believe rate cuts are likely by mid-2026. So they're projecting that there's going to be a rate cut probably by mid-2026, and the most likely outcome becomes a gradual step down, not aggressive though. So, you can kind of scroll and look all the way down here. I would say by the very end, they think that by late 2026, markets strongly believe rates will be meaningfully lower. That signals expectations of slower growth and maybe cooling inflation. Then you see the tail end of the year. They say the markets expect rates to stay lower, but stable, not any emergency cuts, just very normalized policy. So big picture here on this, guys. If you want to take away from this chart that can be confusing, I would say rates are expected to stay high in early 2026. They're going to have a gradual rate cut expected to start mid-2026, and then most of 2027 expected to live in a lower but not cheap rate environment. So markets believe the Fed will avoid extreme moves, and long-term markets think rates could rise again if inflation returns. So interesting chart. This chart shows that what people think the Fed will do with interest rates in the future. Right now, most people think rates stay high for a while, then slowly come down in 2026. We'll see. As far as this chart, it does change daily, by the way. So although that is daunting, changes every single day. Every inflation report, jobs report, or Fed speech can move these probabilities from this chart. And here you can see the history of rates on here where it's coming down from February 25, December 25. And look, it's looking good. It's coming down. It's coming down from the low sevens down to the low sixes. But, again, every inflation report, jobs report, or Fed speech can kind of affect these rates. And that's it I got on mortgage rates, guys. That's all we got there. Now let's now dive into some fun market stories. So I always like to end my Monday market update with market stories for my real estate agents, for my loan officers that may be watching, of some great talking points to talk about with your clients or online. People are interested in real estate, and a lot of people aren't much interested in mortgages except for loan officers. But I like to make it so my consumers somewhat at least like to watch some of the stuff I go over. So let's go over this. So this first one I like, this is from Housing Wire. This is a great article from Rachel Bader at Housing Wire. It talks about the U.S. housing market in 2025. It's a great recap. Overall, the theme here is they call it a year of normalization. So you take a look, inventory rose 16.4%, and 39% of listings saw price cuts as the market normalized. So when they say it's normalizing, there's a little bit more time on the market. People aren't getting as much equity as they have in the last 3 or 4 years, which has been quite ridiculous if you think about it. You buy a house for 2 years, you get $100,000 equity. That's pretty crazy. The history of America hasn't really been that fast. So that's what they're trying to slow down, right? But overall, the median price on this is great. $419,950. Price per square foot is around $209. Days on the market are 84 days. That's up 9.1% from last year. And active inventory in the United States, 757,763 homes, which that is where we're up 16.4%. And again, price reductions are there. Inventory made its comeback. So it also talks about the hottest markets right now in the United States, according to the Market Action Index. This is a really cool tool that measures the balance between supply and demand. And Greenville, NC, North Carolina, took the highest with a median price of $339,000. We got New Hampshire. We got Reading, Pennsylvania, $424,900. Pretty a decent supply and demand in that area. Rochester, New York, and San Jose, California. They said top markets by Market Action Index as well was overall Rhode Island, New Hampshire, Massachusetts, Connecticut, and Michigan. And where the money moved. So a ton of inventory moved in the Miami area. Obviously, Los Angeles, Long Beach, New York, big markets, Dallas, and Houston. And the highest price points stayed coastal, Santa Barbara, San Jose, Honolulu, Nampa, California, LA. Overall, what defined 2025 on this normalization? More supply, less urgency, stable prices, softer pressure, and more realistic sellers. So nearly 4 in 10 listings saw price reductions and also seller concessions as well, and a return to normal. The market moved away from extremes. So pretty good stuff. And, if you ever have a chance to use this data, go to housingwire.com. They got some great data there that you can use, and it's great for real estate agents to look at. They have also certain zip codes of each area. It's really great. You can take a look at the equity, the days on market, median price. Pretty awesome. All right, let's go to one below. Bank statement loans, more mortgage options on self-employed buyers and homeowners as rates ease. So bank statement loans, this is a great article here by Darren Sapini of Housing Wire. Let's talk about bank statement loans and why it matters so much. Right now, bank statement loans are getting a lot more popular for people that are self-employed. So, it is definitely something that is flexible. It helps it during tax times right now. Let's say you need to invest more in your business and you write a lot more off. Don't fret. If you have good credit and you have enough for a down payment, you can do what's called a bank statement loan. What we do is we take and calculate all the deposits the last 12 to 24 months. And, we take a look at it and we use all those deposits, and we have an expense ratio letter that can help calculate that. And it's a really good loan. I mean, they got 30-year fix. Some have a 4-year fix. I don't really recommend doing some of those. But majority of the 30-year fix, they have some adjustable rates, and it's pretty good. So, a bank statement loan can be strong. Again, if you're self-employed, you write off a lot, you have stable deposits, but inconsistent taxable income, and your business is healthy, but your tax returns don't reflect that. And you're shopping in a high-cost market. So it really does have a pretty good area. This is for business owners, entrepreneurs, freelancers, let's say commission earners, 1099 gig workers, real estate professionals. And it really is something right now it's great. It's evolving, and it's something where the rates are actually pretty comparable. I wouldn't say necessarily as conventional, but they are something that's really good for you guys to take a look at that. Great article here. Another thing to talk about here, how long it takes to save for a down payment on a home. So realtor.com, they have some good stuff here. They were talking about basically saying that it takes about 7 years for a typical home buyer to save for a down payment, but that timeline varies dramatically by the region. So from less than 2 years in affordable metro with a large military population to nearly 4 decades in a coastal city. So yes, in the coastal, most expensive place, it's going to take a while. But for context, a typical home shopper put down under $14,000 in the third quarter of 2019. By the third quarter of 2025, that upfront amount has more than doubled to $30,000. So they're saying it's depending on the area of how long it takes for you to put a down payment on a house. For a VA loan, actually, if depending on your entitlement and all this other stuff, you don't necessarily have to put down a down payment. You have to take a look at your entitlement there. But they're saying anywhere between 2 and 7 years. But right now, certain areas like Tennessee, it takes about 2.5 years. Houston, 3 years, and Birmingham, Alabama took about 4 years for people to save. So people are saving money, first-time home buyers. There are some programs for first-time home buyers, if you are one and you want to look into that, to help you buy a home with zero down. They are out there, and we do those as well. And then lastly, let's talk, before we wrap this up, the rate lock effect. How are we looking on the rate lock effect? Now, what is the rate lock effect? So this is ultimately what's freezing a lot of the home prices. Now, yes, we are up in inventory, which is awesome. But the rate lock effect is there's a lot of people that are in the 3% or less range rates, and that's keeping them from selling. They're like, I have a great rate. I have a great payment. I don't necessarily like my house. I don't love my house. I actually need to and want to move, but I'm not going to because my payment is $1,400 in one market or $1,800 in one market or $2,200 in one market. And I don't want it to get to X amount in this market. So it's really kind of easing right now compared to where it was before. A couple of years ago, obviously it was, 40, 50, 60% of people had a rate under 3%. Now it's easing and coming a little more neutralized. And that's where the more and more people where they have, life events that are happening. For example, they have to move. They have a job offer that, either they turn their house into rental, but then they're still going to have to go get another home. They're custom. These people are accustomed to having mortgages. So they get a mortgage and now their new mortgage rate is 6.2. The more and more people that have kind of the higher rates there, that's going to ease the rate lock effect. You're going to see this house that's in icicles is going to melt a little bit, and we're going to start to see a little bit more normalization. It just depends on how slow can we get this to melt. And that's the biggest thing is what we're finding out right now with the rate lock effect. How are we looking? We're getting closer to normalizing this situation for most people just because of one word, time. Time. 2020, you bought your first house, you have a great rate, you have 2 kids during that time, maybe 3 kids during that time, you bought a townhome, you want a yard now, you want to have an area for your dogs, you want an area for your kids. People are having to move because of jobs. People really do really well every 5 years in their career. Well, their career 2020 compared to their career now, 2026, they're going to get a new job offer. They're going to go somewhere else. So a lot of stuff looking on, but these are stuff I talk about. If you have any, questions of how to post stuff like this, make this your background when you talk, reach out. UMortgage has a lot of loan officers that can help you with this. We are one of the top, I would say, companies in America that have really good loan officers, post a lot of good content online. We have a great blog at UMortgage.com that talks about all this kind of stuff as well that we use. A lot of loan officers take advantage of that at UMortgage. We have a great marketing team that gives us tons of ideas of good top stories that are hitting. That's why we can do presentations like this for 30 minutes and do a great job because we have a great marketing team here. So that is it. Let's open up for any questions for you guys. I am here as a guest. We all know the main men that are the best of the money market updates are on vacation, but I like to step in. I've always been a decent bench warmer, but when I come off that bench, guys, I always deliver. So appreciate you guys. You guys have a great week. Enjoy. Have a fun New Year's. Seriously, do something fun.